Hey guys, welcome to lesson number 5, credit spread. So this is a great strategy for people who like to trade directionally. This is going to come into effect in the last lesson, lesson number 6, when we talk about customizing different strategies based on different entry rules, which is awesome because if you have a complex strategy, that's the lesson for you, so stay tuned. But credit spreads are very much of a directional play. Everything that I taught you up to this point is very much of a passive strategy where like you don't really have to know where the market's going to make money, but credit spreads, you actually kind of want to know where the market's going to be able to do this well. So what markets do credit spreads work best in? Well, if you're doing a call credit spread, you're looking best at sideways markets and bear markets. So range bound and downtrending markets is what call credit spreads are for. Put credit spreads are for range bound markets and bullish markets, so markets going up. Who this strategy works best for? Someone who enjoys actively managing their trades and likes charting and trend following, because you kind of need to know the general direction the market's going before you put this trade on. And it's for someone who has a smaller account. Now, credit spreads are a defined risk trade, which means that we're capping how much we can lose, which means that our buying power is a lot less. So you can do this on a smaller account. Cons of this strategy: you need to be able to assess and predict the market direction to have the best outcomes. What are your trading account and size and limits? You need a full margin account, which means that if you're trading with Tasty Trade, you need to have the works accounts. And again, if you're gonna do this on futures, which is not required, you need to enable it on futures as well. So again, if you're trading this on ES, we're talking about $1,000 of buying power, depending on the strikes you select. If we're doing it on SPY, we're talking about $500 of buying power, depending on the strikes and quantity you select. How this trade is constructed. So a put credit spread is structured by selling a put and then underneath it buying a put. And so this is just like one of the legs for the iron condors in the last strategy we talked about, where we do a put credit spread and then a call credit spread, and that defines it. But now this time we're just doing one. So if we do the put credit spread down here, we want the market to go up. So if we actually chart this out here, a put credit spread, we're going to sell a put here. Oops, that's a terrible straight line. We're going to sell a put here, and then we're going to buy a put here. And this creates a defined risk trade that makes money as the market goes up. If it drops below here, that's where we start losing money. But anything above here, as long as the stock stays above this level, then we make money. Same thing, but in reverse with the call credit spreads. We're going to sell a call and then go above it and buy a call. This defines our risk, but it makes money as long as the stock stays below this level. That means the stock goes down, we make money. The stock goes sideways, we make money. The stock goes up just a little bit, but stays below, we make money. So that's how the call and put credit spreads work from a structure dynamic. Best days to go out. Again, you can actually trade these, I should say, 0 to 45 days is best. I mean, I'm just going to change that because these are traded more on a shorter term basis because you're trying to catch those trends and you're trying to catch those moves. It's less about a general strategy like the 112 where it can make money in virtually any market. Credit spreads are more, you're doing the faster trends. So this is what the profit and loss graph for it looks like. We have a capped risk amount, a capped profit amount. They're typically not equal. You typically have a larger risk than profit, but that's how it looks. Now, how do we manage this trade? Well, Tasty Live, because it's defined risk trade, typically it says 21 days until management, which means that when there's 21 days or less left in the trade, that's when we close the trade. We don't really have to have a stop loss on it because we bought or sold that other option. We're now defining that risk, so we actually already have a stop loss built in. Next is take profit. You typically manage your profits between 10 to 50%. And so that's what's so great about this is that we can actually still put a profit target on this, even though we have the capped profit. We can be like 50% of it, 20% of it, whatever we want, and we can take that off. The smaller the profit, the faster our trade will hit that target, and the faster we can close that trade. Next, best practice for the strategy. Put credit spreads 16 delta and 5 delta. Again, that's for a longer width. Again, there's so many different ways to structure this trade. It really just depends. But this is the best practice that is typically done. What Tasty Live has also done on occasion is go with 30 delta and then just buy and then just buy the next option near it. I've done that as well. But again, so there's so many different ways to structure a credit spread. But again, 21 days until expiration is the early management, and we're doing about 50% of the initial credit received as our take profit target. Now, again, if you click down below, you'll get access to this document. You can walk through step by step how to automate this trade. But since you have me on video, let's do it together. So if we go here and we go on create an auto trader, we connect our Tasty Trade account, and we're going to click on create an auto trader. We're going to pick the strategy we want, which is credit spreads. Then we need to define the deltas we're going to do. Okay, so by default, I put in the one that I like, which is very safe. It's a 30 delta, 25 delta. So again, you give yourself about a 70% win rate ratio there, but you also have your risk defined. That's about 45 days out. But again, if you want to go in shorter, like 7 days for that shorter trends, you can. We'll be getting more into that though in the next lesson. Next, you determine how often you want to enter this trade. So for instance, once a week on Wednesdays is kind of what you would set up here. Take profit, it's about 50%, and early management is about 21. Now, when you're doing defined risk, 40 to 50% is a good range, but I'm just going to say 50 for this example. Buying power allocation, what we're looking at is typically, it just depends on the account size, but this takes less buying power. So again, just 2,000 would be more than enough for this trade. If I save and continue, we're looking about $1,000 for this trade per trade. So that'd be about 2 trades. So it's not bad. So that's how we structure and create a credit spread auto trader. I hope that makes sense. If you like trading directionally with defined risk and want it automated, this is how you do it. If you want to learn more about the specifics of entry and setting up like crazy bots based on customizations, make sure to watch the next lesson, and I will see you there. All right, guys. Hope you enjoyed it. Let's go to the next lesson.